Then we talked about the expected return on risk-free asset equal to risk-free interest rate plus inflation premium plus risk premium. Sometimes these two terms will be used as a one term, risk-free interest rate plus inflation premium. This one, it will be interest rate on a government bond. So interest rate on a government bond, sometime it will be here. This is the cost of equity capital. Then example, determine the cost of equity. One is cost of equity, second one is the cost of debt. And these are two are the cost of capital. Okay, first one, we have to determine the cost of equity. Capstone Corporation needs to raise $55 million for the micro CSP project described in example 11.1. Capstone's target capital structure calls for a debt ratio of 0.4, indicating that 33 million dollar has to be financed from equity. And another, if you subtract 33 from 55, this one will be $22 million will be the debt. So in other ways, you can find out $55 million into 0.4. This is also 22. So 22 will come from the debt, and the remaining one, they are trying to gather from the market, to be financed from equity. The pertinent information is as follows. Capstone is planning to raise 33 million from the financial market. Capstone's beta is 2, which is higher than 1, indicating that the firm is perceived to be riskier than the market average. The risk-free interest rate, RF, and risk-free interest rate is the RF given 5.47%, and the RM is given 13%. And micro CSP project is a normal risky project compared to the firm's market risk. Determine the cost of equity. We know the cost of equity formula is RF plus beta into RM minus RF that we studied here. RE equal to RF plus beta bracket RM minus RF. So you are getting 20.53%. This represents if Capstone finances the project criteria from its equity funds, the project must earn at least 20.53% return on the investments to be worthwhile, assuming that the project is about the same as the average risk of the company's assets and operation. So this is the cost of equity that will be used to finance the operation. And the micro. Then cost of debt capital, another term, because in the capital we have to the cost of equity. We can evaluate the expression after tax cost of debt equal to pre-tax cost into 1 minus tax rate. So this one we can write in the way ID is the after tax cost of debt equal to CS by CD into KS 1 minus TM plus CB by CD into KB into 1 minus TM. So let's talk about the TM is the marginal tax rate. TM, 1 minus TM, 1 minus TM. Tax rate, 1 minus tax rate means TM. So 1 minus TM, 1 minus TM will be used in both cases. Pre-tax cost will have two ways. One is the one for the loan, another for the bond. Okay. So now let's talk CS is the loan term. CS related to the KS, CB related to the KB, B representing the bond, S representing the loan. Okay. So that's why total is the CD. Total is the CD. CD is the total value, cost of capital, cost of debt. CD is the debt. So cost of debt here, CS is the amount of the term loan, cash the before tax interest rate on the term loan, then CB is the before tax interest rate on the bond. One is for the loan, one is for the bond. And when if you write down the CS by CD, it will be a fraction. And this fraction will be used as a multiplication form with CKS. Here, the function will be multiplied with KB relatively. And in every cases, we have to multiply 1 minus TM, means the tax rate. Now, this is as the CD, the amount of bond financing means the CD equal to CS plus CB. Okay, this will be CD, not CB. Okay, so CD equal to CS by CB. Now, another problem that we can see, the determining the cost of debt. Previously, it was the cost of equity. Determining the cost of equity, example is 11.7. Now the example is 11.8 is the determining the cost of debt. So for the case in example 11.7, suppose that Capstone decided to finance the remaining 22 million. Okay, let's see the previous example. Capstone needs to raise 55 million, and among the 55 million, they decided to get the money from the cost of equity, 33 million. So the remaining is 55 minus 33 is the 22. Okay, that's why so they decided to finance the remaining 22 million by securing a term loan and the bond. Okay, as it is the cost of debt, so it has two branches. One is for the loan, another one is the bond. So 22 million will be representing here with the term loan and issuing 20-year 1,000 per year per bonds. So one will be loan, one will be bond under the following condition. So source here, term loan, you can see the amount. So these all are the interest. So amount 6.6 million, its fraction is 0.3. And rate is 12.16% per year. On the other hand, bonds is 15.4 million and the fraction is 0.30 and the rate is this one. Carefully mind it, if you add term loan and bond, it will become the $22 million. Okay, $22 million and the fraction, if you add up, it will be 1. And another two rate are given here. So Capstone marginal tax, TM is 40%. This is expected to remain constant in the future. Determine the after-tax cost of debt. Okay, we have to find out the after-that cost of debt. Now given, very easy problem. So KS is given, KS is the before tax interest rate on the loan is given 12.16%. KB is given 10.74%. And here CS by CD is given 0.3 and CB by CD is given 0.7. Now the TM is given. TM is 40%. Well, this TM, this tax rate, TM is given 40%. Now we have to find out the ID. ID because this is the after tax cost of debt. Now, if you put the all the values in the equation, ID equal to, we know, CS by CD into TS into 1 minus TM plus CB by CD into TB into into 1 minus TM. So then 6.70%. What does this 6.70% interest really mean? Even though you are borrowing the money at 12.16% and 10.74% from two different sources, your net cost of composite borrowing will be just, net value will be just 6.70%, as debt interest payments are tax deductible expenses. So this is the result that same example we can use, and we can calculate the cost of capital by using this formula, and another one is the cost of debt by using this formula. So this is okay here. So the company cost of capital. Another one is the company cost of capital. Whole company's cost of capital. The company cost of capital is the weighted average cost of capital, or simply cost of capital is the rate of return that the firm must expect to earn on its average risk investments in order to provide a fair expected return to all its stakeholders. Now, calculating the company's cost of capital, assuming that a firm raises capital on the basis of the target capital structure, and that the target capital structure remains unchanged in the future, we can determine a company cost of capital, which is weighted average cost of capital, simply cost of capital, in this formula. Here, K is a cost of capital for company, means the company cost of capital, or WSCC equal to same ID into CD by V plus IE into CE by V. As you know, D is the debt, CE is the equity. As it is a cost of capital, it has two main branches. One is the cost of debt, and another one is the cost of equity. If it is cost of debt, it will be divided into another two that we studied. One will be the bond, another one will be the loan. Okay. So where CD total debt capital, such as bonds in dollars, CE total equity capital in dollars, B is the total value, CD plus CE, and IE average equity interest rate per period considering all equity sources, ID as it is a debt after tax average borrowing interest rate per period considering all debt sources. And K is the weighted average cost of capital, or company cost of capital. Note that the cost of equity is already expressed in terms of after-tax cost, because any return to holders of either common stock or preferred stock is made after payment of income taxes. So now let's see financing sources. One is the short-term loan, and another one is the long-term bond. Okay. So one is loan, another one is the bond. So if you take it, capital structure here, the cost of debt, we know previously. And what about the cost of equity? Retained earnings, the preferred stocks and the common stock. As it is a stock, if you have a stock, or if you, then it will be the equity. Okay. And this one will be the cost of equity, CE, and CD debt. CD debt and CE equity, if you sum up, it will be the B. B is the total value. Okay. B is the total value. This is the capital structure. There are two types of capital structure. Financing sources may be like this. And after that, cost, we have to find out the cost. One is the ID. We can easily calculate ID, just previously we calculate. And another one is the IE. Also, we have calculated the IE. Once you have calculated ID and IE, and we have the B value, CD value, CE value, finally we can calculate capital company cost of capital. K, cost of capital company. So this same things is written here, plus minus. So sometime it will be representing as increase risk premium for a highly risk project. Sometimes it will be very risk. If you take a risk project, risk will be increased. Another one, the reduce risk premium for a less risky project. Okay. This is a whole matter that will represent the cost, company cost of capital. Now the example, okay. Let's see the example. I am telling you that three kinds of cost of capital. One is the cost of equity. There is also one mathematical example I said you and I discussed. Second one is the cost of debt. Also the example is given. Third one example is example 11.9, calculating the company cost of capital. Reconsider example 11.7 and 11.8. The marginal income tax rate TM for Capstone is expected to remain at 40%. 40% in the future, assuming that Capstone's capital structure, when the debt ratio also remains unchanged in the future. Determine the cost of capital. K means the company cost of capital. K representing the company cost of capital of raising 55 million in addition to Capstone's existing capital. Capstone has some existing capital, but they are trying to raise their capital to 55 million. In the 55 million, there are two terms. One is cost of equity, another one is the cost of debt. Okay. And also in the cost of debt, there are two, one representing the bond, another one is representing the loan. So now the previous 11.7 and 11.8, if you see, here the CD value is 22 million. CE value, cost of equity is 33 million given in 11.7 and 11.8. And B is the total value that we just said, the B equal to CE equity plus CD debt. So this is the 55 million. Now ID is given in the previous slide 6.70 that we got the ID value. You can see here ID value 6.70 is the cost of debt. And cost of equity 20.53. Also, we have got the 20.53. You can see 20.53 is the cost of equity we got. Okay. And finally, we have to calculate the marginal cost of capital, means the total company cost of capital, K. Okay, K. Now, just simply you have to write an equation that I said here, this equation, K equal to ID CD by V plus IE CE by V. Now, then put the value, then you get the 15%. This 15% would be the marginal cost of capital that a company with this capital structure would expect to pay to raise 55 million US dollar. And this is the discount rate to be used in evaluating the Capstone's new investment project. In other words, the project must return more than 15% in order to be justified. This is the marginal. This is the marginal value. Obviously, its actual value must be more than, okay. So by this way, so what we have understood that initially in the cost of capital has two terms. One is the cost of equity. We can find out the cost of equity value, and then cost of debt. In cost of debt, there are two terms. One is for the bond, another is for the loan. And by this way, you can calculate the cost of debt. When you got the cost of capital and cost of debt, then you can go for the company's cost of capital or marginal cost of capital. And finally, you will see that your marginal cost of capital is representing the whole company's cost analysis. Okay. not IE, not ID. You see the IE is 20%, but ID is 6%. Okay, one is very high, another one is very low. So this is not the representation of your all tax activities or the financial activities. That's how we have to go for the company's cost of capital that represents all the cost analysis. And by this way, we are getting 15%. And okay, now the project cost of capital right now. Okay. Now the project cost of capital. Previously, it was the company cost of capital. So type of cost of capital, company cost of capital. Now the second one is the project cost of capital. The project cost of capital can be different from the company's cost of capital if the firms uses the capital raised from all sources put in a project whose risk is different from the risks of existing business operation. The risk adjusted discount rate refers to this project cost of capital. The project cost of capital can be analyzed by the risk adjusted discount rate approach. This is another cost of capital, that is the cost of capital for only one specific project. Risk adjusted discount rate approach, it is important to distinguish between the risks of project and the risks of company. If a risk of company invest in a low risk project, okay, carefully mind it, it should discount the cash flows at a correspondingly low cost of capital. On the other hand, if it invests in a high risk project, those cash flows should be discounted at a high cost of capital. So the most common way to do this is to add an increment to the discount rate, that is, discount the expected value of the risky cash flows at a rate that includes a premium for risk. The size of the risk premium naturally increases with the perceived risks of the investment. This discussion implies a simple rule. The rule is the discount rate of a project should be the expected return on a financial asset of comparable risks known as the project cost of capital. Now the calculation, if you see this calculation or if you understand this one, you can easily understand the cost of capital. Project cost of capital. This example is 11.10. Risk adjusted discount rate approach for the project cost of capital. Reconsider example 11.6, where the expected cash flows for the capstone projects are, okay, cash flows in the period of 55 million US dollar, 55,000 US dollar, you know. This is negative below, means it has invested. In the first year, the cash flow is positive 17094. In second year, it is increases. Third year increases. Fourth year increases. Fifth year also increases. This is the cash flow analysis for every year. Okay, total 5 years. First year, initial year, first year, second year, third year, fourth year, fifth year, and sixth year. Okay. Start in 0 year, first year, second year, third year, fourth year, and fifth year. Suppose that Capstone consider the micro CSP project to be just one of their normal risky projects, then the appropriate discount rate to use is 15% as calculated previously. Okay. Thus previously company's discount rate we calculated 15%. However, Capstone considers the micro CSP projects to be much riskier than the normal project. So it believes an additional risk premium of 6.93%. Okay, additional risk premium. and should be added. Okay. If management had decided to use a risk adjusted discount rate of 21.93%, okay, now management has adjusted because previously, the discount rate is 15%. Now additionally 6.93%. What is the total value? If you add these two value, it will be 21.93% to compensate for the uncertainty of the cash flows. Is the project acceptable? We have to decide, as it is a economic decision. Okay, you have to decide the investment. So now you need to determine whether the project under consideration is of normal risk. If not, you need to come up with a desired risk premium to add. And annual cash flow given in the most likely values and equal to 5, here. Total number of tax period is the 5 years. And here K that we calculated in example 11.9 is the 15%. And additional risk premium is given also 6.93% to cover up the risk. And the total value 15% plus 6.93% is equals to 21.93%. Now is being used to compensate for the uncertainty of the cash flows of this specific project. Now the decision of yours to tell about the acceptability. Project will be acceptable or not, or it will be a good project or not. Okay. Then calculate the net present value, P value. P value is in this project cost of capital. So present work value, okay, PW value at the rate of 21.93, here 21.93 is equals to initial value, the initial investment. Okay, so this initial investment divided by the here the 1 plus r that you understand. In previously I have told you that the 1 plus r to the power n, 1 plus r to the power 2, and 1 plus r to the power 3, 1 plus r to the power 5, 4, 1 plus r to the power 5. Okay. R is 0.2193 and 1 plus, because it's in each and every time you have to find out the present value. Okay. And so as it is minus A0 divided by 1 plus r to the power 0. So the downward value will be 0, will be 1. Okay. Something to the power 0 means 1. So this value has come. And second one is the first year cash flow, 17,094 divided by 1 plus r to the power 1, as it is a first year. But first term 1 plus r to the power 0, because it is a initial year. So 1 plus something to the power 0 means 1. Just the numerator value will come here. Negative means that it is invested. Okay. And second one, maybe you have understood that this value divided by 1 plus r. R value is 0.2193 to the power 1, as it is first year. Second value is 20,493 divided by 1 plus r to the power 2, because it is second year. Plus third value divided by 1 plus r to the power 3, plus fourth value divided by 1 plus r to the power 4, plus finally fifth value 29,660 divided by 1 plus r to the power 5. And then if you calculate it simply with your calculator, you will get the value of 3,989, which is greater than 0. As it is greater than 0, because the present work value is still positive, the investment is attractive even after we adjust for further risk, as 6.93% further risk premium is added to the existing project, although that it has some, maybe you thought that it has some maybe uncertainty. After calculation, you are getting the positive value of PW as it is greater than zero. So obviously we can tell the project is acceptable. Okay. And I think this 64 slide, up to this, I want to conclude today's class. And tomorrow and next Tuesday, I want to take a quiz, okay, in my class. Syllabus is until this, okay? এই পর্যন্ত সিলেবাস দেওয়া যাবে? Siar, Angela, are you here? Can you hear me, please? So, if I tell you here the engineering economic decision, cash flow analysis, discounting and compounding, and cost of capital. Until this is your syllabus, and the first quiz will be in coming Tuesday in my class. Okay.
Please mention the last page number up to which the syllabus.
Slide number is 68. Is it 68? No. 60. Oh, no, okay. Is 64. 64.
Okay, sir.
Okay. Today, this is the end of this today's class. Maybe I will call you in your physical class, the roll call. Okay. Today, no roll call. I have another meeting, so please let me go. Thank you very much. Inshallah. Next Tuesday, I will take your quiz one and some short question, and the maths will be there. Okay. Inshallah.
Okay.
Thank you very much.
Assalamu alaikum, sir.
Assalamu alaikum, sir.